What happened to Silicon Valley Bank? Silicon Valley Bank, SVB, was shut down in March 2023 by the California Department of Financial Protection and Innovation. Based in Santa Clara, California, the bank was shut down after its investments greatly decreased in value and its depositors withdrew large amounts of money, among other factors. Later in March, First Citizens Bank bought up all deposits and loans of the failed bank. Bank failures like this have happened before. There were more than 550 banks shut down between 2001 and the start of 2023.1, but this one was particularly newsworthy. Not only did it come at a time when many people in the US already feared a recession, but it was also the largest bank to fail since Washington Mutual closed its doors amid the financial crisis of 2008.2. To help you understand what exactly went wrong with Silicon Valley Bank, we'll dive a bit deeper into the history of the bank, the events leading up to the collapse, and what it means for depositors, investors, and the economy in general. Key takeaways. 1. Silicon Valley Bank, SVB, the 16th largest bank in the United States, was shut down by federal regulators on March 10, 2023. 2. The bank's failure came as a result of several factors, including its investments losing value and its depositors withdrawing large amounts of money. 3. In the aftermath of the collapse, federal regulators promised to make all depositors whole, even for those funds that weren't protected by the Federal Deposit Insurance Corporation, FDIC. 4. The Federal Reserve took steps following the collapse of SVB to improve confidence in the banking system and prevent future banking failures, including its Bank Term Funding Program. 5. First Citizens Bank struck a deal with the FDIC to buy SVB's deposits and loans, as well as certain other assets. Why did Silicon Valley Bank fail? Silicon Valley Bank saw massive growth between 2019 and 2022, which resulted in it having a significant amount of deposits and assets. While a small amount of those deposits were held in cash, most of the excess was used to buy treasury bonds and other long-term debts. These assets tend to have relatively low returns but also relatively low risk. But as the Federal Reserve increased interest rates in response to high inflation, Silicon Valley Bank's bonds became riskier investments. Because investors could buy bonds at higher interest rates, Silicon Valley Bank's bonds declined in value. As this was happening, some of Silicon Valley Bank's customers, many of whom are in the technology industry, hit financial troubles, and many began to withdraw funds from their accounts. To accommodate these large withdrawals, Silicon Valley Bank decided to sell some of its investments, but those sales came at a loss. SVB lost $1.8 billion, and that marked the beginning of the end for the bank. 7. Some people believe that Silicon Valley Bank's failure started far earlier with the rollback of the Dodd-Frank Act, which was the major banking regulation that was put into effect in response to the financial crisis of 2008. As a part of Dodd-Frank, banks with more than $50 billion in assets would be subject to additional oversight and Rules. 8. But the 2018 Economic Growth, Regulatory Relief, and Consumer Protection Act, signed into law by President Donald Trump, significantly changed that requirement. Instead of setting the threshold at $50 billion, the 2018 law increased it to $250 billion. 9. Despite being the 16th largest bank in the country, Silicon Valley Bank didn't have enough assets to be subject to the extra rules and oversight. If the threshold was never changed, SVB would have been more closely watched by regulators. A timeline of the collapse. From an outside perspective, the failure of Silicon Valley Bank happened rapidly over the span of just a couple of days. Here's a timeline of events. 1. March 8. Silicon Valley Bank announced its $1.8 billion loss on its bond portfolio, along with plans to sell both common and preferred stock to raise $2.25 billion. 7. In the aftermath of this announcement, Moody's downgraded Silicon Valley Bank's long-term local currency bank deposit and issuer ratings. 10. 2. March 9. The stock for Silicon Valley Bank's holding company, SVB Financial Group, crashed at the market opening. 2. Other major banks also saw their stock prices take a hit. 11 Additionally, more SVB customers began withdrawing their money, for a total attempted withdrawals of $42 billion. 3. March 10, trading was halted for SVB Financial Group stock. 13 Before the bank could open for the day, federal regulators announced they would take it over. 12 After regulators were unable to find a buyer for the bank, deposits were moved to a bridge bank created and operated by the FDIC, with a promise that insured deposits would be available by Monday, March 13. 4. March 12, federal regulators announce emergency measures in response to the Silicon Valley Bank failure, allowing customers to recover all funds, including those that were uninsured. 15. 5. March 17, Silicon Valley Bank's parent company, SVB Financial Group, filed for bankruptcy. 16. 6. March 26, First Citizens Bank bought all of Silicon Valley Bridge Bank except for $90 billion of securities and other assets that remained in FDIC receivership.